Houston, October 1973. Two oil executives sit in adjacent offices. Both manage energy portfolios. Both are responsible for supply chains that keep American factories running. Both are watching the same news. Arab oil producers have just announced an embargo. Oil prices are about to quadruple. The first executive holds contracts denominated in dollars, fixed price agreements, hedges through futures markets, paper instruments designed to manage price risk. On his balance sheet, everything looks protected. The second executive had done something different 6 months earlier. He had purchased physical storage capacity, leased tank farms, filled them with crude when prices were stable. Not as a speculation, as insurance. When the embargo hit, the first executive watched his paper hedges fail. Counterparties defaulted. Futures contracts settled in cash that could not buy oil that did not exist. His factories went dark. His company lost 40% of its value in 6 weeks. The second executive kept his factories running, not because he predicted the embargo, because he understood that in a supply shock, paper claims on oil are not the same as oil. His company tripled in value while competitors collapsed. It wasn't luck, it was what they held. The Strait of Hormuz is 21 miles wide at its narrowest point. Every day, approximately 21 million barrels of oil pass through it, 1/3 of all seaborne traded oil, 1/5 of global oil consumption, a single choke point through which flows the energy that powers the modern economy. If Iran closes that strait, it does not create an oil crisis. It creates a supply shock that makes 1973 look mild. And the question is not whether your portfolio is diversified. The question is whether you understand the difference between paper claims on resources and the resources themselves. History has tested this distinction repeatedly, and the lesson is always the same. Paper fails, real assets endure. The people who survive are those who understood the difference before the crisis forced them to learn. The pattern appears across every major resource disruption in modern history. The mechanics change, the names change, but the structure remains identical. 1967, the Six-Day War, Egypt closes, the Suez Canal. It remains closed for 8 years. Shipping routes to Europe are cut. Oil tankers must circumnavigate Africa. Transportation costs explode. Companies with physical inventory positioned near consumption centers survive. Companies dependent on just-in-time delivery, based on paper supply contracts collapse. 1979, the Iranian Revolution. Oil production falls from 6 million barrels per day to effectively zero within months. Not because of war, because of political upheaval. Global oil markets seize. Prices double, then triple. Futures markets experience forced liquidations. Physical holders simply wait. Their barrels appreciate while paper contracts blow up. 1990. Iraq invades Kuwait. 4 million barrels per day of production goes offline overnight. The first Gulf War begins. Oil spikes from $17 to $40 per barrel in weeks. Paper hedges provide no protection because the issue is not price volatility. The issue is availability. There is no amount of money that can buy oil that is not being produced. The universal principle is simple. When supply chains break, financial instruments that derive their value from those supply chains break with them. The instrument and the underlying asset are not the same thing. During stability, this distinction does not matter. During disruption, it is the only thing that matters. The Strait of Hormuz presents this dynamic in its purest form. Not because Iran has never threatened to close it. They have. Repeatedly. In 1984, in 2008, in 2012, in 2019, each time markets react, prices spike, then things normalize. The strait remains open. The threats are dismissed as bluster, but the distinction between threats that are not executed and threats that cannot be executed is critical. Iran has the capability to close the Strait of Hormuz, not permanently, but for a period of time long enough to create catastrophic supply disruption. The mechanics are straightforward. Iran possesses anti-ship missiles, sea mines, fast attack craft, coastal artillery. The strait is narrow, shallow in places, difficult to navigate. A concentrated military effort could render it impassable for commercial traffic within hours. The United States Navy could reopen it, but not immediately. Mine clearing takes time, weeks at minimum. During those weeks, 21 million barrels per day of supply does not reach market. Global oil inventories, which currently stand at approximately 60 days of consumption, begin to drain immediately. This is not a price event. This is a supply event. And supply events cannot be hedged with financial instruments, because the instruments settle in currency, and currency cannot be converted into oil that is not available. The first consequence of a Strait of Hormuz closure is that oil futures markets break, not because of price movement, because of delivery failure. Futures contracts are promises to deliver a commodity at a specified price on a specified date. When the commodity cannot be delivered, the promise becomes worthless. Contract holders receive cash settlement, but cash settlement at what price? The last traded price before trading was halted. The theoretical price based on supply and demand models. The price means nothing if there is no oil to buy with the cash. This happened in natural gas markets during the Texas freeze in February 2021. Futures contracts settled, but there was no gas to take delivery of. Industrial users who depended on financial hedges rather than physical supply contracts simply shut down. The hedges paid out in cash. The cash could not buy gas that did not exist. The second consequence is that global oil inventories deplete rapidly. 60 days of supply sounds substantial. It is not. Global consumption is approximately 100 million barrels per day. The Strait of Hormuz accounts for 21 million of that. If the strait closes, the market loses 21% of supply immediately. Inventories begin to drain. Not slowly, rapidly, because consumption does not decrease proportionally to supply loss. Demand is inelastic in the short term. People still need to drive to work. Factories still need energy to operate. Airlines still need jet fuel. At 21% supply loss, inventories drain in approximately 75 days, not 60, because some production can be increased elsewhere. Strategic reserves can be released, but there is no realistic scenario where 21 million barrels per day of lost. Supply is fully replaced quickly. The third consequence is that price becomes irrelevant as a signaling mechanism. In a normal market, price balances supply and demand. When supply falls, price rises. Higher prices reduce demand and incentivize additional supply. The market clears. In a supply shock, price cannot clear the market because the supply is not available at any price. Oil is not produced, it is extracted. If the oil cannot physically reach refineries, price is meaningless. This is the distinction between a price crisis and a supply crisis. In 1973 and 1979, prices rose dramatically, but oil continued to flow. Supply was reduced, not eliminated. Markets adjusted through price. A Strait of Hormuz closure is different. Supply does not reduce, it stops. For the countries that depend on that supply, price becomes irrelevant. The oil is simply not available. The fourth consequence is currency stability breaks down in affected regions. Countries that depend on Strait of Hormuz oil and have insufficient reserves face an impossible choice. They need oil to keep their economies functioning. They must bid for the limited available supply. Bidding means spending foreign currency reserves. When reserves deplete, currencies devalue. Import costs rise. Inflation accelerates. Not monetary inflation from central bank policy, real inflation from actual scarcity. Goods cost more because the inputs to produce them cost more and are not available in sufficient quantity. This creates a feedback loop. Currency devaluation makes imports more expensive. More expensive imports accelerate reserve depletion. Faster reserve depletion accelerates devaluation. The cycle continues until reserves are exhausted or supply is restored. The fifth consequence is that energy-dependent paper assets lose value regardless of the underlying business quality. A company with strong fundamentals, low debt, and excellent management becomes worthless if it cannot obtain the energy needed to operate. This is the flaw in traditional portfolio diversification. The portfolio may be diversified across sectors and geographies, but if all the holdings depend on the same energy supply chain, the diversification is illusory. In a Strait of Hormuz closure, airlines cannot fly without jet fuel. Shipping companies cannot operate without bunker fuel. Manufacturing plants cannot produce without energy. The stock becomes worthless, not because the business is bad, but because the business cannot function. This is why real assets matter. Physical commodities, energy storage, agricultural land, productive assets that do not depend on continuous supply chains to maintain value. These assets do not appreciate because of the crisis. They maintain value while everything else fails. The historical record shows this pattern clearly. Every major supply disruption creates the same dynamic. Financial claims lose value. Physical assets hold value. The distinction between the two becomes unmistakable. In January 2026, global oil inventories stand at approximately 60 days of consumption. This is within normal range, not low by historical standards, not high, adequate for managing typical supply disruptions. But 60 days assumes normal consumption and normal supply disruption. A Strait of Hormuz closure is not a normal disruption. It is a 21% supply loss that cannot be quickly replaced. The United States is now a net energy exporter. This provides some insulation, but the oil market is global. A supply shock in the Middle East affects prices everywhere, and price affects everything. Current global debt levels are unprecedented. Total global debt exceeds $300 trillion. Debt service costs are manageable at current interest rates and current economic activity levels. But debt service becomes unmanageable when economies contract. A sustained oil supply shock contracts economies. Energy is the input to all economic activity. When energy supply falls, economic activity falls. When economic activity falls, debt service capacity falls. When debt service capacity falls, defaults increase. This is not a prediction. This is arithmetic. The question is not whether this chain of events would occur. The question is what percentage of supply loss for what duration would trigger it. History suggests the threshold is lower than most people assume. The 1973 oil embargo reduced supply by approximately 5 million barrels per day. Global consumption was only 60 million barrels per day, an 8% reduction. Prices quadrupled. Economies went into recession. A Strait of Hormuz closure would be a 21 million barrel per day reduction from current consumption of 100 million. A 21% reduction, 4 times larger than 1973. The economic impact would not be 4 times larger. It would be exponentially larger because modern economies are more energy dependent, more leveraged, and more interconnected than in 1973. The historical record shows that supply shocks destroy paper wealth systematically. Stocks fall, bonds default, currencies devalue, real estate values collapse in regions that cannot obtain energy. The only assets that maintain purchasing power are the physical commodities themselves and the means to store and transport them. This is not about predicting whether Iran will close the Strait of Hormuz. Prediction is not possible. The decision depends on political calculations, military capabilities, international pressure, and internal Iranian dynamics that cannot be forecast. The question is what happens if it occurs? And the answer is clear from historical precedent. Supply shocks reveal that paper claims on resources are not the same as resources. Financial instruments designed to hedge. Price risk do not protect against supply risk. Diversification across paper assets provides no protection when all the assets depend on the same supply chain. The distinction between paper wealth and real wealth becomes unmistakable, not because the paper becomes worthless in absolute terms, but because the paper cannot be converted into the physical goods needed to maintain economic function. The people who understand this distinction prepare differently. They hold physical assets, energy storage, commodity inventory, agricultural land, productive capacity, assets that generate value or maintain utility regardless of whether supply chains function. They do not hold these assets because they predict a Strait of Hormuz closure. They hold them because they understand that supply chains are fragile, that geopolitical stability is not guaranteed, and that the difference between paper claims and physical assets matters most when it seems to matter least. The executive in Houston in 1973, who filled tank farms with oil, did not predict the embargo. He understood that in energy markets, physical supply and financial claims on supply are fundamentally different things. That understanding saved his company while his competitor failed. The same understanding applies today. The Strait of Hormuz is the most critical energy chokepoint in the world. The supply that flows through it cannot be quickly replaced. The financial instruments that claim to hedge the risk do not actually hedge supply disruption. They hedge price volatility during continued supply. When supply stops, the instruments fail. Not because they are badly designed, because they are designed to solve a different problem. They provide protection against price changes when oil continues to flow. They provide no protection when oil stops flowing. The question is not whether to avoid all paper assets. For most people, that is neither possible nor necessary. The question is whether to recognize that paper claims on resources are not the same as resources, that supply chain disruptions create different risks than price volatility, and that the historical pattern is consistent and predictable. Supply shocks destroy paper wealth. Physical assets endure. The people who survive are those who understood the difference before the crisis, made the distinction obvious. The strait is 21 miles wide. 21 million barrels per day flow through it. If it closes, the world does not end, but the world changes. And in that change, the difference between what you own on paper and what you own in reality becomes the only difference that matters. When the next supply shock comes, it will not matter what your portfolio statement says you own. It will only matter what you actually hold.